He's like, I'm alive.
Yes.
So
let's go ahead and look at these problems on page 242. We're going to do problem 1 and problem 2. So, where am I? We have Z Corp. We have D, who owns 24 shares. We have C, who owns 23 shares. We have B, who owns 25 shares. And we have A, who owns 28 shares. So, question 1 says, what if Z redeems 7 shares from A? So, this is looking at Rev Rule 76-364. So, before the redemption, A could control the corporation with any other shareholder. Now, after the redemption, A basically has 21 of 93 shares. In order to basically control the corporation, you have to have a vote of 37 shares. So, are there any other shareholders that A could partner up with to get 47 shares? No, it's not possible. Once A goes down to 21 shares. So here, since before there were 100 shares, and A had 28 of 100. And you had to have really 51 shares to control. And A could basically partner with any other shareholder and reach control, but after, she can't work with anybody. So, is this going to be not essentially equivalent to a dividend under 302B1? Yes, which means it will be a sale or exchange, right? Do we see what is happening here?
No, not at all.
Okay, so we have A, and they're getting redeemed of 7 shares. Before the redemption, A had 28 of 100 shares. And it would take 51 shares out of the 100, basically, to control the corporation. A could work in conjunction with either B, C, or D to get to that 51 shares. After the redemption, A goes to 21 shares out of 93. It would take 47 shares out of the 93 in order to control the corporation. If 21, there is basically no other one shareholder that A could partner up with in order to reach 47 shares.
Because it's need 26 more?
Yeah.
Because that has it.
Right, exactly.
Yeah.
This is the specific facts of this revenue rule. Okay, what we say is, if a shareholder goes from basically being able to control the corporation by working with one other shareholder to not being able to do that after the redemption, then we say that is a meaningful reduction, so 302B1 is met. And of course, someone always asks, well, or I would ask, well, what happens if they're not redeemed of 7 shares, but, they're redeemed of, say, 4 or something? Well, now we get into this, I don't know the answer. You know, it's very subjective, very fact specific. You would just have to do research. But this specifically, this situation here falls under the facts of Revenue Rule 76-364 and would be a meaningful reduction.
So we assume that they're all friends and that if they can just partner up with someone to get control?
Yes. Well, yeah, that's pretty much what you're assuming.
Okay.
Under the facts of this road rule, or that, you know, they can partner up with another one, you know, it's just what this road rules does. Okay?
That is weird.
And I think it says that in my outline, yeah, under, on page 13, number 3. Even if not in control, if a shareholder loses the ability to control a corporation by acting in concert with only one other shareholder, and all three are unrelated, then there is a meaningful reduction.
Yeah, but I guess it's just because he lost the ability to do that altogether, if he could have found, even if they're unrelated, get somebody to help him.
Right. Okay. Z redeems 5 shares from A, and A and D are mother and daughter. Okay, so if we're assuming that A and D are mother and daughter, then before the redemption, A has 28 shares directly, plus 24 shares indirectly, which equals, hold on, looking at the wrong number, sorry, 52. So that means A and D before the redemption have 52% of the corporation. They're 100 shares. Okay. And then after the redemption of 5 shares, right? Is that what it says, 5 shares? Okay. Now A has how many shares directly? 23, plus how many indirectly? 24, which equals 49%.
47.
It's, he did the percentage, not the.
I'm sorry.
It's
Sorry,
47
sorry.
shares.
You're right. 47 shares out of 95,
It's 40.
which equals 49.4%.
That's not
Is that it?
Yes.
Yeah, that's it. All right. So, what do you guys think here? Is this going to be a meaningful reduction that is not essentially equivalent to a dividend?
Yes.
Yes. Why? Because we're going from 52% to 49.4%.
And they lost.
Now, let's see. And although we're not doing the calculation, you know, if you were to do this calculation under 302B2, you would say 80%, so this is our 50% test, net, and then 80% times 52% equals, does someone have that? 80 times 52, I didn't write that in my notes. What? 41%, approximately. So is this less than this? No. So what that means is if you were to run through the numbers for 302B1, which you would do first, it would be no, it's not, does not satisfy 302B1 because of the 80% test. Does everyone see that? But then you were to turn to 302B1, since we are going to below 50%, it should satisfy under 302B1 and be a sale or exchange for A. Okay, now under the next one, Z redeems 5 shares from A, and A and B are mother and daughter. Okay, so B has 25 shares, right? So before, they owned 53%, or A is attributed to owning 53%. And after, she has 48 over 95, which equals 50.5%. So now, if you go and do 302B2, you're not going to meet the 50% test, first of all. And what about a meaningful reduction? Is there a meaningful reduction here? No, because you're not under the 50%. So if there's not a meaningful reduction, then what is this going to be classified as? Right, a distribution under 301, and it will be a dividend to the extent of earnings and profits, which we don't have that information here to be able to make that determination. Okay, and then the next one, same as C above, except that A and B has not spoken to B since B married outside her faith.
Doesn't matter.
Right, you can't use it under 302B2. So our question is, can we waive the attribution rules under 302B1 because of family discord?
No, you said it's some cases.
Yeah, it's maybe yes, maybe no. There has to actually be a reduction in ownership, which there is here. So since we're going from 53% to 50.5%, there does have to be a reduction, and there is. So since there's a reduction here, you could consider family discord in determining whether to turn off the family attribution rules. But who's to say if that's enough? Like, how long have they not spoken? Just says they haven't spoken. Well, how long has it been? You know, what were the terms of this separate? Sounds like something. My husband is a family law attorney. Yesterday, I was at home and he walked in and he's like, "I've got bad news." And I'm like, "What is that?" He's like, "Yesterday, one of my clients shot one of my other clients." I was like, "How did that? They're okay." I was like, "How did that happen?"
So that qualifies family discord?
Surely, yes. I was like, "Oh my gosh." I was like, so I guess they know each other. So maybe like, yeah. I was like, "So what are you gonna do?" He's like, "Well, now I can't be either one of them's attorney. I'm conflicted out." And I was like, "Okay, well, that stinks." All I think is great. Now we're not getting much money, but okay.
Question on a test, if you ask us, like, if it's a question like this, you just say maybe.
Maybe. Sorry, maybe. Maybe.
Really don't need to ask
I don't
that.
know. I don't care.
Really subjective, but for it to be considered at all, it has to be under 302B1, and there has to be a reduction in their ability to exercise control. If there is a reduction, then maybe you should consider it. Is it going to be enough? I don't know. Depends on what the judge says. I can guarantee you what the IRS will say. You don't get anywhere with them. Okay. Next problem. All right. So we have Y, and they have 100 shares of common stock and 100 shares of non-voting preferred stock. The preferred stock is not convertible into Y common stock and is not Section 306 stock. We're not going to have time in this class to talk about 306. I've skipped it. The Y common and preferred stock are owned by the following unrelated shareholders. So, if you're looking at this, I'm gonna erase this. So we have A, B, C, D, and E. And then we have common and preferred. A owns 40, 0. B owns 20 and 55. C owns 25 and 10. D owns 15 and 15.
0 and 20.
Thank you, 0 and 20. Okay. So the first question, if Y redeems 5 preferred shares from E, is that going to satisfy 302B1? What do y'all think?
Wait,
So we're redeeming 5 preferred shares from E. What do you think? So would it satisfy 302B2? Absolutely not, because all you have is a redemption of non-voting preferred shares. But what about 302B1?
maybe.
Since all E owns is non-voting preferred shares, a redemption of any of his non-voting preferred shares is going to satisfy 302B1. Because E doesn't really have any control over whether he's redeemed or not. First of all, he only has non-voting shares. And 2, if he's losing 5 of his preferred shares, he is losing his right to participate in current earnings and the right to share on assets and liquidation. So, yes, that would be satisfied for E. Sale or exchange. Okay, now, next question. What if Y redeems all of this outstanding preferred stock? So we have a redemption of all of these shares. So, first of all, remember I said that the rule is that if you have a redemption, basically, and these shares are held like proportionately by their shareholders, then it can't satisfy. Are they held proportionately here?
No.
No. So what that means is we have to analyze each shareholder separately to determine what their treatment is going to be under 302B1. Okay, so since you only have a redemption of non-voting shares, I can tell you now, it's never going to satisfy 302B2, right? Because 2 of the tests in 302B2 have to do with voting shares. And if all you have is a redemption of non-voting shares, that's not ever going to satisfy 302B2, okay? So let's talk about E first. So what's happening with E?
Same thing as last time.
It's gone.
It's gone. So, I mean, this could also satisfy as a complete termination, right? 302B3. He's losing everything. We already said E satisfies from the last problem. I mean, he's definitely going to get satisfied here. So that's definitely going to be sale or exchange. Okay, what about A?
No,
No.
doesn't lose
A
anything.
is not losing anything. A is not even getting any share. A is not even getting a redemption, right? Because he doesn't own any shares. So A, we don't even have to consider because A owns no preferred shares. Okay, now, so what we have here is a redemption of non-voting preferred shares. So when we're looking at our elements, we have to consider this category 2 and category 3. Because this redemption only involves non-voting shares, this one is really irrelevant to this redemption. So this is a perfect example of when we have to go to category 2 and 3 to determine if it's a meaningful reduction. So let's look at D. What do y'all think with D? If he's redeemed 15 of his shares, how is this affecting his right to receive assets or receive earnings? It's really not affecting him at all. Because if you think about it, before the redemption, he had 15 preferred shares. which meant he got basically 15% of the right to participate in current earnings for the preferred shareholders. And after, since there are no more preferred shareholders, what's going to be his take? Still 15%. Is there a meaningful reduction for D? No, not a meaningful reduction, so we're going to be under 301 for D. Okay, now let's look at let's look at C.
Same as B.
So with C, what's happening with C here?
They're getting more.
He's getting more. This redemption is not a meaningful reduction for him at all. He's getting more because he's going from getting 10% of the preferred take to afterwards, since there's no more preferred, he's getting 25%. So definitely not going to satisfy for C. What do you think about B?
But it was satisfied because he lost
He
like
lost
35%.
Yes, that's right. B is going to be satisfied because he's basically going from a 55% preferred take of category 2 and 3 to a 20% take. So he has a significant reduction. So he's going to be resale or exchange. Okay, does that make sense?
Can you say the last one again?
Yeah, so B, before the redemption, he got 55% of the preferred take of the right to participate in earnings and the right to share in assets on liquidation, because he had 55% of the preferred shares. And then after the redemption, since all the preferred shares are gone, now his take has gone down to 20%. So he has a significant reduction in his ability to take earnings upon liquidation or assets. Make sense? Okay. Now, last category, which we're running out of, we don't have a whole lot of time left, so I want to go through the last category, and then we'll go through one other thing.
So you need to know problem number 3.
No, well, problem number 3 is pretty simple. Really.
Is it test problem?
Is it what?
Test problem?
No. It's not a test problem. It's more like a think about it problem. So, if you want to do it, we can come to my office and we can talk about it. Let's go, we need to move on. So to the next category here, which is the last category, 302B4. Which is a partial liquidation. And I was telling Gaga what I'm going to do since I was not here to lecture on chapter 4 as soon as I finish making the exam, which hasn't happened yet. But I will get it done in the next, sometime in the next 3 days. I'm going to email y'all and let you know what problems you need to make sure that you know or you're familiar with from chapter 4, because I wasn't here to emphasize the things that I wanted emphasized. And then that way, as you're studying, if you realize, oh, I'm kind of blurry on this and I know this is going to be tested, you still have time to come and ask me questions.
Can you do the same for the chapter 5?
No.
Like the main?
No.
Why no?
No. Because you've been here. I've been here. Okay. It's grad school, you know? No test reviews anymore. But I did a little different with chapter 4 because I wasn't here. And I don't really know how his lecture was. So let's go ahead and look at the next category, which is 302B4, which is partial liquidations. Now, what is interesting about this test is it is tested from the corporate level. So all the other tests we have done have tested at the shareholder level. This one tests at the corporate level. We want to know what is happening at the corporations. Are they getting rid of a significant amount of their assets? Are they getting rid of one of their lines of business? So that's what's happening here. Let's look at the code under 302B4. Redemptions from a non-corporate shareholder in a partial liquidation. So you should underline the words non-corporate shareholder. This is on page 35 of your code book. This only applies to non-corporate shareholders. It applies if such distribution is held by a shareholder who is not a corporation, okay, and in partial liquidation of the distributing corporation. So, if we look at 302E on page 37, it says partial liquidation defined. Right, now we have a lot more information in the code on what exactly is a partial liquidation. A distribution shall be treated as a partial liquidation if the distribution is not essentially equivalent to a dividend determined at the corporate level, and it is pursuant to a plan and occurs within the taxable year in which the plan is adopted or the next year. So we have this vague standard of not essentially equivalent to a dividend. So we have not essentially equivalent to a dividend and is adopted pursuant to a plan and happens in that tax year or the succeeding year, up to succeeding year. Okay, so, and it says that the not essentially equivalent to a dividend standard is tested at the corporate level rather than at the shareholder level. This is very vague, which is why Congress came up with a statutory safe harbor, which means if you fall under the provisions of this safe harbor, then you are considered to be not essentially equivalent to a dividend. The statutory safe harbor is under 302E2. If you fall under E2, you are considered to be not essentially equivalent to a dividend, okay? If, and this is on page 15 of your outline material, partial liquidation status, if the distribution consists of the assets of a qualified trade or business or is attributable to the termination of such a trade or business. So we have a distribution of the assets of a trade or business, I'll put T or B, or, make sure I get it phrased right, or attributable to the termination. What that means is you sell the business to somebody else and you distribute the proceeds. attributable to the termination of such business. Okay? And the trade or business disposed of has been operated for 5 years and must not have been acquired by a taxable transaction during that period. Okay, and then third, the remaining business, so what you have left after the distribution has to have a similar 5-year history. So this is the safe harbor under 302E2. So if you meet this safe harbor, then you are presumed to be not essentially equivalent to a dividend. Now, if you don't meet this safe harbor, you could still be not essentially equivalent to a dividend, but it's a more hairy, iffy, look to the case law type standard similar to what we just looked at. It says here in my notes, a distribution may qualify as a partial liquidation, even if the shareholder doesn't surrender any stock. So that's interesting, okay? Even if the shareholder doesn't surrender any stock, if the other requirements are met under this safe harbor, then we'll still consider it to be a redemption. Okay, even if no shares are actually redeemed. It's considered to be a constructive redemption. Again, this does not apply to corporate shareholders. S-corps are treated as corporate shareholders. That's important to note. And there is a rev rule in the book. It's 79-184. What this rev rule stands for, in a nutshell, is that you can't distribute the stock of a subsidiary. You can, but it doesn't count as a partial liquidation.
So pretty much the whole page of the rule involving is what's just.
Yeah, pretty much. Sure. And if you look on page 16 of my outline material, it does kind of like summarize it for you, but I summarize it even more, which basically says a distribution of the stock of a subsidiary. If you do that, then that's not going to be considered to be a partial liquidation. Okay, so let's look at the problem on page 247. Okay. So I'm going to draw this out. So we have Alpha Corporation, and we have a shareholder M and a shareholder P, and they're married. And then we have Iris Corporation, and then Alpha Corporation has 2 divisions. Often when you see divisions, they'll just be drawn out as a circle under the corporation. All that means is it's not a separate entity, like, I guess it could be an entity under state law, but for tax purposes, it's not gonna be treated as a separate entity. It's just like a branch or a disregarded entity. They have books, which is one division, and then they have crayons, or test prep, which is another division. They also own shares in a corporation called Beta, and Beta has some sort of operating business, I forgot what it is, something related to computers. And then they also have a stock portfolio. So, the first question. Alpha has operated Books and Cram for more than 5 years. All right, good. We know the 5-year rule is met. And it distributes the assets of Books to its 3 equal shareholders in redemption of 5 shares from each shareholder. So, what do you guys think with this one? What about Iris? Are they going to get redemption treatment under 302B4? What do y'all think? What's your name with the glasses?
Kristen.
Kristen, okay. What do you think, Kristen? You're shaking your head no.
No,
Why
because
is
it's a corporate shareholder.
That's right.
Yeah.
And I'll tell you all a story. When I was at PwC, I was in a meeting and I was with some big partners and they were talking about this, this code section. And one of them was talking about this and they forgot that it had to be couldn't be a corporate shareholder. And I reminded them and I sounded so smart. Okay. I did a lot with this code section when I worked there. So, because I did mergers and acquisitions and international tax, and a lot of games are played with this code section. Okay, so what about M and P? So they're related. Will this satisfy as a redemption for M and P? What do y'all think? Yeah, right? I mean, for M&P, because remember, what we're looking at is we're testing this for Alpha, and they're getting rid of an entire business. They're getting rid of the book business. So we're concerned about testing from the corporate level, and since books is being distributed up to its shareholders in redemption of its shares, for M&P, it's going to be a sale or exchange under 302B4. But for Iris, it is not because they are a corporate shareholder, okay? Now, would it matter if M&P did not actually receive any shares?
Yeah.
No. There is an exception. It's called the constructive redemption. I hate it when they talk about things and then I can't quote where they are in the code. I don't have that in my notes, but
What did you say it was called?
it's called a constructive redemption. So even if they aren't actually giving up any of their shares, so long as the statutory safe harbor is met, it's considered to be a constructive redemption. And I want to find out where that is. Okay, I found it. It is actually from Revenue Ruling 9013. It's always good to, write that down, not necessarily because you'll need it in this class, but when you start working, I found that when I was working, I would refer to my notes and my outlines from school a lot, just to try to figure out where to start on research. Where to start in the code, or if there was a certain rev rule or a certain case that I should look at, just to help me get started on figuring out where to go. Because where I worked, you're not ever asked any questions that you learned in school. You know, if it's something that you've learned in school, it's not gonna be something somebody asks, at least not where I worked. It was, you know, big companies with difficult questions, and, you know, they already had in-house tax people working for them to figure out the easier questions. But the hard ones would get sent to, you know, their big four accounting firm, and we would get to answer them. But it would give you a good place to start. So, now, where are we at here? Oh, I'm on the wrong page. Okay. Is there a different result in A above if Alpha had purchased books 3 years ago for cash? If so, why should that matter? So, now, if Alpha had purchased books 3 years ago for cash, you are running afoul of this right here. Now, one thing I want you to note, it says operated for 5 years. That does not mean it has to be operated for 5 years by the corporation doing the redeeming. It just has to be operated for 5 years by somebody. Okay? We are not saying that Alpha Corporation had to have operated books for 5 years. What we are saying is it has to be operated by somebody for 5 years, and during this 5-year time period, it was not purchased or acquired in a taxable transaction.
So you don't know?
So the answer is no, because it was acquired in a taxable transaction 3 years ago. Okay? Now, it says, what if it had been purchased in a tax or acquired in a tax-free reorganization 3 years ago?
Well, it depends.
Well, now
The books.
you would be back into the safe harbor because it was not acquired in a taxable transaction. It is acquired in a tax-free reorganization. So long as, you're right, so long as it had been operated for 5 years. We don't necessarily know that from the facts. So long as somebody was operating this business for 2 years before it was acquired as a taxable reorganization, then yes, it would satisfy the safe harbor. Does that make sense? You see, it's kind of,
So if you would get a question like this, you would just say, we don't know because we need more details to.
or what I would say is, if it was me, I would say, assuming that it has been operated for 5 years by somebody, then the answer would be yes. And that's what I would say. You know. But hopefully you'll have enough facts where you don't have to make an assumption. Sometimes I miss things and I don't realize it, because I have to make these exams and sometimes I miss things, but, all right. What if all the assets of books were destroyed by fire, and Alpha distributes 1/2 of the proceeds equally to its 3 shareholders, and retains the remaining proceeds to carry on its book publishing business on a smaller scale? What do you guys think under the safe harbor rule? So, it's not going to be met under the safe harbor because they're not terminating the business, right? They're still continuing to operate the books business on a smaller scale. And they're not distributing all of the proceeds. So you're not going to satisfy this safe harbor. But remember what I just said, or I said earlier. And if you look at the language and the code, it will make sense to you. You can still be found to be not essentially equivalent to a dividend, even if you don't meet the safe harbor. What it means is you have to go to the case law And it's very subjective, very factual. And in fact, the book discusses a case that has facts very similar to this. And the question became in this case, is it going to be enough of a corporate contraction to qualify under 302B4? I don't know, right? You just have to research it. You know, it depends. You have to see what circuit you're in, what does the case law say. It is not a straight black and white answer. It depends on if this is enough of a corporate contraction to be considered not essentially equivalent to a dividend. You definitely are not going to fall under the safe harbor. You may fall under this. You have to do research. I know y'all like hate those answers. Sorry. I don't make the law. Okay. Okay, next one. Same as A above, except that Alpha distributes the assets of books to Michael in redemption of all his stock. All right.
Wouldn't he still have 50% because he's live? Because then it would be half.
So, yes, well, this one is going to satisfy it, you know, because it doesn't have to be a redemption to all the shareholders. But if it is, and I guess I didn't mention this earlier, and I probably should have. Under this test, 302B4, you can have a pro rata distribution, and it still qualify this test. This is really the only test where you could have a pro rata distribution and it still be found to be a sale or exchange. Why is that? Because the testing is done at the corporate level. Okay, this really is and in fact, it says that in the code, that you can have, it says it under, if you take a look at 302E4 on page 37 of your code book, it said redemption may be pro rata. This is the only test where you could have a pro rata redemption and it be found to be a redemption, or sale or exchange, sorry. But it doesn't have to be. And in this problem, Michael is the only one that's redeemed of his stock. This happens when you have a shareholder and maybe they're not getting along with the other ones. Maybe M and P are getting a divorce and you want Michael out of there. So we're going to redeem him of his shares so he's out of the picture and we can keep running our business as we see fit. So is this going to be a partial liquidation for Michael? Yes, it will be, but it will also be which one? Which other test is going to be met?
Fully redeemed.
That's right, 302B3, a complete termination, because he is losing all of his shares, which is the easier one to apply, rather than going through this question of is this a partial liquidation? He's losing all his shares, he's
Yeah,
out.
I might be mixing stuff right now, but he does lose all his shares, but also Ifanella is his wife and she has pretty much afterwards 50% of the shares, doesn't that?
You're right, it does. But what happens under 302B3? What do we waive?
Waive
Family attribution rules, right? Which would be his wife. Right? Good point. Okay? Okay, E. Same as A above, except that Alpha distributes the assets of books to Iris in redemption of all its Alpha stock. What do y'all think?
Yeah. It's termination.
So it would qualify under 302B3, right? A complete termination for Iris. Would it qualify under 302B4, a partial liquidation? No, why is that? It's a corporation, that is right. Since Iris is a corporation, they cannot fall under 302B4, but since Iris is being redeemed of all of its shares, it would fall under 302B3, a complete termination. Okay? Alpha distributes the securities portfolio to its 3 shareholders in redemption of 20 shares from each shareholder. Okay, and I guess I haven't been saying this as we go along, but Iris could never fall under 302B4. Okay, I'm not going to say that again. Doesn't matter about M&P. I mean, we'll discuss M&P in a second, but because Iris is a corp, they're never going to be under 302B4. But what about M&P in this situation?
Yes, they are.
So, under Rev Rule 6322, it says that hold on a second. I think I might have. Yeah, I drew this wrong. Sorry about that. I was like, this doesn't make sense with what I'm looking at. Alpha also has the securities portfolio, not Beta. So if Alpha is distributing the securities portfolio, under Revenue Rule 6322, it says that a securities portfolio is not an active trader business. So since this is not an active trader business, it is not going to qualify under B4 as a partial liquidation. So it does have to be an active trader business. Next, G, Alpha sells all of its Beta stock and distributes the proceeds pro rata to the shareholders in redemption of 20 shares of each. So, what do you guys think about this one? No, this one does not qualify as a sale or exchange because of the Rev Rule that we just discussed and is in the book, Rev Rule 79-184, which basically says if you sell the shares of a subsidiary and then distribute those shares, that is not going to qualify under 302B4 as a partial liquidation. And is it going to satisfy any other test? No, because it's a pro rata redemption. Okay, H. Same as G above, except that Alpha liquidates Beta and then distributes the assets of Beta's business, which Beta has operated for more than 5 years. Okay, so what is happening here, and we'll discuss this in chapter 7. All right, I've already got it over here. Is what we have is Beta is liquidating. And all of its assets as part of this liquidation, which by the way is a tax-free liquidation, as we'll discuss in chapter 7. But we have a liquidation of Beta into Alpha. And then, so Alpha now owns the assets of Beta, and then Alpha distributes these assets up to its shareholders. Is that going to satisfy 302B4 for M&P? Yes, it will. So note how this is actually different from the facts in that Rev Rule. Because under the facts of the Rev Rule, Alpha sold the stock of Beta to somebody else and then distributed those proceeds up to MP and Iris. And with this, Beta actually liquidates into Alpha. That means Alpha now owns these assets, and the assets are redistributed to the shareholders in redemption of their shares. So that'll satisfy under 302B4. Okay, so I want to quickly discuss section E. Now, I know I said in the syllabus that we are also going to cover in this chapter section G, which is on page 25, but we're not gonna have time, which is probably fine. Last time I covered it in like 10 minutes, and it's too difficult to do in 10 minutes, so it didn't work very well. So you're not responsible for that. And really, you're not responsible for any other part of the chapter after this one, okay? This part right here.
MVP.
Huh?
MVP.
What?
Stop
So
that
we
reading.
don't need to worry about pretty much anything on page
251.
253.
Yeah. We just like don't have the time, so I have to pick and choose. But I leave all the material in there because you might be practicing or studying for the CPA exam and you want to use it for a reference. So I leave it in there, okay, but you're not testing them. All right, so this whole section, all it's saying is what are the tax consequences to the parties with a redemption. So we've already been talking about the shareholder, right? So if the shareholder has a basis in their shares of 50, receives $100,000 cash redemption of all of their shares, then this shareholder is going to have gain of $50,000. If this were considered to be, let's say instead of redeeming all their shares, they're only going to redeem half of them, okay? Now, if we have a dividend, right, then we'll go under the 301 rules, right, which we've already talked about. So we've already kind of been talking about the shareholder consequences along the way, and we really said all there is to say. But with the corporation, if what the corporation is distributing is property with a built-in gain, you still have to worry about Code Section 311B, which you guys discussed in Chapter 4, which says the corporation does have to recognize gain if it distributes property with a built-in gain. But it will not be able to take a property that has a built-in loss. So if it has a loss and they distribute it, you cannot use the loss. But if it has a gain, the corporation does have to recognize that gain. So what we're saying is if this corporation is distributing an asset, so not cash, but an asset that has a built-in gain, the corporation is going to have to recognize a gain for that distribution. So, but if all they're doing is distributing cash, then there's nothing for the corporation to pay, to recognize. There's no gain in cash. Does that make sense? Okay, I know it's getting a little late. So, the book does talk about the effect of earnings and profits in the corporation. This is, so if it's classified as a dividend, okay, under 301, you guys have already discussed the effect of E&P with the 301 distribution. Okay, you've learned that in Chapter 4. How that works, the E&P are decreased by the amount of the dividend. So if it's just cash, you decrease it by cash. If it's property, it's decreased by the fair market value of the property. And then if there is gain recognition by the corp, they're going to increase their E&P. Now, what about if it is a sale or exchange under 302? Now, how do you determine the effect of the E&P? It can be a little hairy to calculate. The code says under 312 and 7, and if you take a look at 312 and 7.
Did you said E and P decrease with dividend and increase with the gain?
Yes, so if the corporation recognizes the gain, so let's say we have a corporation and they are distributing a piece of property with a $20,000 basis to the corporation, and $100,000 fair market value, and they're distributing this property to the shareholder, then the corporation is first going to increase their E&P by the amount of the gain, which is $80,000. And then they're going to decrease their E&P by the amount of the distribution, which is $100,000. Now, what about if it's under 302? So if we look, 312N7 addresses this, and it basically says, it's on page 50. It says that we do reduce E&P for the amount that is chargeable to earn E&P in an amount not in excess of the ratable share of E&P. Oh, lovely. So, and there is a good example in the book of how this works. This is on page 249. And in this example, I'll probably just do the example and not do the problem, because honestly, the example is pretty much really similar to the problem, I'll say. Or I'll go through the problem quickly. It's really similar. So, in this problem, or its discussion in the book, we have X Corp. It's on page 249. And then we have A, which is a 50% shareholder. And then we have B, which is a 50% shareholder. A buys its shares. They buy 500 shares for $20 a share. And the same thing with B. X has $100,000 of net assets, which includes $50,000 of cash and $50,000 of real estate. And has $50,000 of accumulated E&P. X redeems A 500 shares for $50,000. So we have a $50,000 redemption to A for A's 500 shares. So for A, will this be a sale or exchange or a dividend? What do y'all think? So is A losing all of her shares? Yes. So, yes, complete termination under 302B3. So that means A is going to have a sale or exchange. So what is A's basis in her shares? So if she buys 500 shares at $20 a share, it's $10,000, right? And how much is she receiving? 50. So we have a $50,000 amount realized minus a $10,000 basis equals a $40,000 gain recognized for A. Now, since this problem is about the corporation, let's talk about the corporation. The corporation is not going to have any gain to recognize, right? Because the corporation is just distributing cash, okay? But what about the effect on the corporation's E&P? Since this is going to be classified as a sale or exchange, we have to look at that rule under 312N7, I believe it is. So, and look at the ratable share of E&P. Since A is a 50% shareholder and A is being redeemed of all of her shares, we basically are going to reduce E&P by 50%. Because A is a 50% shareholder, we attribute 50% of the accumulated E&P to A. So we're going to reduce E&P by $25,000, which is half. So that means the ending EMP is going to be $25,000 as a result of this 302B3 redemption.
So do we only do that with accumulated EMP or also the EMP for the year?
Okay, so that's a good question, and that is discussed in Revenue Ruling 74-338, which is outlined in the notes, and it's discussed briefly in the book. So what it says is, it does accumulated ENP for purposes of this code section. I believe it says it in the regs. Yeah, it says under the 1.316-2B regs. It said you do include current ENP, but only the amount allocable to the current distribution. So in fact, that's what the problem, which is on page 250, is about. In this problem, we have facts that are honestly very similar to these facts. There's 100,000, except that there are $100,000 of let's see, current EMP, and there are $100,000 of accumulated EMP. And there is a distribution that occurs on July 1st. A redemption, I'm sorry, that occurs on July 1st. So in the middle of the year, we have a redemption. And we have a redemption of, let me see, what does it say? Yeah, so A has a complete redemption, and the corporation distributes $250,000 of cash to A. So we want to know how much of the EMP is attributed to A. And here A is also a 50% shareholder. So we have A who's a 50% shareholder. So what that means is we're going, since this distribution occurs on July 1st, we're going to essentially get half of the current distribution, of the current EMP. So if we have $100,000 of current EMP, and we're going to get half of it because the distribution occurs on July 1st, then that means we're going to get $50,000 of current. But remember, A is a 50% shareholder, right? So we're actually only going to get $25,000 of current. Now, what about with accumulated? Accumulated doesn't work that way, and since A is a 50% shareholder, we're going to get half of accumulated. We don't have to worry about making it basically prorate for the amount that's done during the year. So that means we'll have $50,000 of accumulated EMP and $25,000 reduction of current EMP. So you'll have a total reduction of EMP of $75,000 for this sale or exchange. Does that make sense, right? Yes, I know it's late. It makes sense. So, does it make sense, Allie?
Yes.
Really all we're doing with current EMP is we have to allocate it based upon the time period in the year that the redemption occurs. With current EMP, you do not have to do that, but you still have to make sure that you are considering the ownership percentage of the shareholder being redeemed. And this can get very hairy if you have a shareholder that's not redeemed of all of their shares. It can be a complicated calculation. Okay, so, again, that's it for tonight. That's it on this chapter. If you're still confused, you can watch the lecture, which I will have to load to YouTube tomorrow. It'll take me a couple hours to get it all going. But Yeah, and I'll send you all out an email with the problems you need to make sure you are familiar with from chapter 4.
Don't forget safety children.
What?
I feel like there's so many like codes